So we're going to continue part two of the video, which is actually for week number one on the review of accounting. So we are on the second part of the financial statements. So we're looking now at the balance sheet. So quickly, balance sheet refers to a listing of the things that we own as a company or an entity. Own means assets, like these are the assets or resources the company has paid for or acquired as part of the business, and also things that are owed by the company. These are the liabilities, and then anything in between own minus owed equals equity, which is basically the residual value or the net worth of the owners of the company. That might be the investors, either a debt investor through a debt financing. So the owner of the company might be the bank if it's 100% debt financing. Why did I say that? Because the bank, uh, when you own something to the bank, normally you would put collateral, your assets are collateralized through the bank. Or it can be the stakeholders or the shareholders of the company that actually is the owner of the company, the residual value. Assets minus liability equals equity. So here, let me use the pointer. So balance sheet indicates that the firm owns and how the assets are financed in the form of liability or the ownership of the interest. Now, we're going to go through some of the items within the balance sheet. We'll start with the assets. So, and then how do we make an interpretation of them in finance? So, assets are listed. So, when we say that, think about the balance sheet. So, the balance sheet has a list of assets, and then it's in the order of liquidity or closest to cash. That's why on any financial statement that you would see in US GAAP, your first listing is actually cash, and then cash is the first line on the balance sheet, and then the next succeeding ones are in the order of liquidity. I would like to say based on US GAAP, generally accepted accounting principles, because there are other types of financial statements based in the IFRS or international um, financial reporting standards that are mostly UK, technically the rest of the world, right? Which might show non-current asset as the first line item in the financial statement. But for now, we are focusing on US GAAP, US GAAP based financial statements. So asset accounts are listed in the order of liquidity. So current assets is a term wherein uh, we basically classify certain items within the balance sheet. In accounting, you have accounts receivable, marketable securities, you have inventory, you have prepayments. So current assets are anything that's within that will be converted into cash within 1 year as of the balance sheet date. Now, for example, I mentioned about accounts receivable. Accounts receivable can be collected and converted into cash within 1 year. Why? Because accounts receivable are normally short term, within 90 days, or normally trade terms are 30 days. You might have a somebody defaulting, not paying on time, and then they would pay within 90 days. So that's why still short term within 1 year. Now, marketable securities is a balance sheet account that is considered a current asset because it will be converted into cash within 1 year. So, meaning that you can terminate that investment or liquidate that investment within 1 year and convert it back into cash. Inventory. Inventory is an asset in the balance sheet that can be converted into cash within 1 year. On what order? I have the inventory, and then I would sell the inventory. So it will be basically revenue for the company because you sell the inventory. And then just in case that the inventory was sold on credit, it becomes now a receivable. And then that receivable becomes collected, then converted now to cash. But it needs to go to certain steps, right? If you are a manufacturer, it means that your inventory will need to be produced, will be converted to will be converted into from raw materials to work in process to finished goods. From finished goods, it will be packaged, delivered, it will be sold, converted to receivables, and then collected and then converted back to cash, right? So you can see that from from AR, accounts receivable, you just need to collect. Pick up the phone. Hey, I wanted to collect your outstanding balance. Can you pay me back? So those are the effort. If it's marketable securities, you just need to terminate in advance that investment. Then that marketable security gets liquidated and goes back to cash. But inventory takes multiple steps. If it's if it's something that's raw materials, you need to convert it, then distribute it. If it's actually a finished goods already, then you just need to be selling it, distributing it, and then collecting it if it's on accounts receivable. So multiple steps, right? Now, prepayment, which is also part of current asset, is a balance sheet item wherein it represents an advance payment that you did for, say, insurance. I prepaid insurance in January 1 of this year, but basically the insurance is for 12 months. So you would expense it out through an amortization method throughout the year. So this prepaid expense. Investments are different from marketable securities. Investments might be long-term. So these are now long-term commitment to funds, and then it can actually be beyond 1 year. So it's not anymore current assets. It might be non-current assets. So plant and equipment, in accounting, sometimes we call it property, plant and equipment, or PPE. Similar term is actually fixed assets. And then here we're calling it as plant and equipment. So these are carried at original cost minus accumulated depreciation. So what's the concept with that? An asset you acquire at historical value, and then when you acquire that, the use of that asset on the company for the company would need to be shown in the income statement through a wear and tear, meaning depreciations, right? So as you go through the years, like a laptop that I bought right now is a fixed asset. I know it would have a life of 5 years. How do I show that? It would mean that I would amortize it or depreciate it. I would say depreciate within 5 years, and then by the end of the 5 year, it will be zero value. So whatever amount, if it's a $5,000 laptop divided by 5 years, so every year you reduce the value of the asset by 1,000. So depending on the policy. Now I mentioned about amortization. I mentioned about depreciation. Amortization pertains to the allocation, systematic allocation of the value of the asset in a number of years. These are assets that are non-tangible, like say copyright, patents, or whatnot. You amortize them. If you depreciate it, it's an asset that's tangible. So that's why I need to correct myself. Instead of saying the laptop amortized, laptop depreciated, because laptops are tangible. So just wanted to make sure that we are clear with the use of the difference between amortization and also depreciation. Now, accumulated depreciation, it can be also accumulated amortization, is the summation of the past and present depreciation charges or currently owned assets. Now here, just want to make sure if I can make it bigger, maybe not. So right now, you have the current assets, you have other assets or non-current, and then that's the presentation, right, on the balance sheet. Then you have here the current liabilities and also the stockholders' equity. Now, total assets. So how do you buy assets? Particularly non-current assets, right, which are property and equipment, are either financed through liability or stockholders' equity. So we talk about that company, in order for it to grow, expansion or whatnot, it needs to have some funding, and then those funding goes back into capital expenditure. Capital expenditure, or CapEx for short, are basically a term to use wherein the company builds new assets, creates new assets, maybe construction of a warehouse, construction of a manufacturing plant, or purchase of assets through a CapEx program, a capital expenditure program, in order for you to grow the business. Buying new machinery would produce more assets or would produce more inventory that would you would be able to grow. For the company that I work for, in order for us to grow on a smaller market in Guam, we need to look at areas wherein we are not delivering fuel yet. We don't have visibility. I work for the fuel company, right? Downstream, meaning we do distribution to end consumers and commercial customers. So this year we're looking at building um, retail sites, three more in Guam, wherein we don't have a presence, but our competitor has a presence. So in order for us to grow, Guam is about 160,000 number of population. So it doesn't grow that big. And then, but we know everybody needs fuel. So what we do is that in order for us to grow, we need to have more revenue. And then it means that we need to have more customer. But with the limited number of population, basically we would need to put more sites that we don't have a representation or we don't have presence on, and then we will get it from the competitor. So basically, that's the logic of the strategy. But in order for us to do that, we need to have a capital expenditure program, which we've been doing, and then we've been using financial techniques in order for us to convince management or the investors, hey, fund our project because it will bring more revenue for the company in the future. A sustainable growth in the future through revenue generating assets funded through we use internal financing. So we don't want to take loans, and then we don't want to ask for more money for our investors. Basically, what we generate as net income, we actually accumulate it to retain earnings and use that as internal funding. Okay, so that's one way of looking at it in finance. And then liabilities represents obligation to the company, things that are owed by the entity. And then these are normally within 1 year. If it's a current liability or a short-term liability, that will be accounts payable. Notes payable can be short-term, but that's why it's notes payable or a promissory note. It can actually be long-term depending on, right? But there are short-term or long-term. So we would say long-term portion of notes payable, short-term portion or current portion of notes payable. And then also, we do have the stockholders' equity. We talk about preferred, common, and then also the retained earnings. Now, so for example, somebody had a common stock of $100, but the shareholder paid 125. So $25 in excess of the par value is called capital paid in excess of par. That's the finance term, but like in accounting terms, they called it APIC. Well, accountants like to have acronyms, so um, some countries would call it APIC. Some countries will call it additional paid in capital. We'll just spell it out, right? So in the US, we call it additional paid in capital. When you go to Asian countries, sometimes they would call it, when you talk to accountants in uh, in Asian countries, they would call it additional PIC or APIC, yeah, additional paid in capital. So it's the same thing. Now, the concept of the book value. So here's a difference between accounting and finance. If I buy land in say in 2020, like say during COVID time, or if I buy a condominium, or we'll just say land. If I buy a land in 2020 during COVID time, it was on a discount. So I bought it for $1 million. And then on the books, the land is shown as $1 million. Now for finance, now in 2024, finance, they look at it, what's the value of the asset as of the now? And then, of course, we talked about it. The finance guy would actually pull out, hey, accountant, can you give me the balance sheet? The balance sheet shows land 1 million. But the finance folks would say, you know what? If I want to tell what's the worth of the company right now, I don't want to use 1 million for that piece of land because right now, in 2024, it's selling as a premium for, say, $5 million. So there's a 4 million pickup or appreciation. So there's always a discussion on the book value. So there's an asset book value question that of course impacts the equity part because asset minus liability equals equity, right? So valuation for finance is actually forward looking or the now, right? And forward looking. Accountants look at it on a historical perspective based on a cost approach. That's why finance or those using finance as a evaluation are mostly financial manager, security analysts, and then stockholders. Now, that's the limitation of the balance sheet, right? So most values are based on historical or original basis. It's very troublesome for property, plant, and equipment, and also inventory. So what do I mean by that? For example, um, if I have inventory back in, say, 2020 that I actually purchased in 2019, then in 2020, I bet you are not selling any of those inventory because of COVID. COVID happened. So now the value should actually go down, or it actually the market value for that inventory is really down because nobody's moving, nobody's buying it. But you purchase it on a higher value because that's how you recorded it for accounting purposes. So valuation is always a challenging thing, right? Now, um, some value or some assets may be worth 2 or 3 times their original cost. We talk about it, say, on the discussion about land, right? And then also, many require many times original cost to replace the asset. That's correct also. And then what do you do with the value of those adjustment to that asset? Do you expense it out? Do you capitalize it? Those are questions on asset valuation. Now, for example, also, think about this one. In our company, we have a building, a part of our group of companies. I know I work with the fuel company, but we also help the parent company or the subsidiary of the parent company that actually does the building management. Now, the building was bought way back in I would say 1987. That's the original one, or earlier than that. Now, those building, when it was valued, it's such historical, right? It was recorded on the books. But right now, because of, say, military development in the Asia Pacific region, maybe picking up of the tourism in Micronesia, so there is a higher value for a piece of land on a strategic location within Guam. Now, when you do an appraisal report, an appraisal, so a real estate company takes a look on the building, the number of tenants, the contracts that are still existing, or how long they are they provisions for growth, for the number of tenants, what's the occupancy rate? When they do the methodology, they would say, hey, the value is now this one, appraised value, might be higher compared to your historical value. For finance, we look at the appraised value because that's the value of the asset now rather than use the historical value. So those are some limitations on the items. Now we talked about the limitations of the balance sheet. In conclusion on that one, it's the asset valuation, especially on appraisal values. Industry outlook. Now, uh, there was one point in time wherein the price of fuel went high because of what? Fuel for us is inventory because we sell fuel. And then the price of fuel went up during the start of the Ukraine war, right? Actually, fuel right now is still high, although declining for the past few months, but still high compared to, say, 2019, 2017, right? Of course, that's long. We call those in practice pre-COVID. Whenever we benchmark our performance right now in 2024, we always pull out, are we now above pre-COVID era or pre-COVID numbers when we do some comparison for accounting purposes or analysis purposes. And then, of course, there are different factors on the share values when you have growth prospects, quality of management, and risk expectation. Now, book value, we know what's book value is basically the equity divided by the number of shares of a corporation. These are the book value per share. The market value is the value is the value of how the stock is trading during that same period of time wherein you computed your book value. So, for example, UPS has a small book value but a higher market value. So it would mean that something is happening wherein there is a buy strategy on Wall Street and everybody wanted to buy. So who's everybody? This can be institutional investors like the BlackRock, a big like a trade union, or maybe a like CalPERS, California Employee Association for pensioners or teachers or whatnot, right? Who's trying to buy big investments for their pension plans. So these are institutional investor, or banks are institutional investors. But retail investors will be you and me using Robinhood or using other platform like Vanguard to buy stocks or E-Trade. Then we are retail investors. So in the market, for those who would want to buy either institutional or retail investors, it's 163.8, but the book value as computed is actually lower. So it means that Wall Street knows something, either an industry outlook. Let me go back there. Ooh. Either an industry outlook or I want to go to the previous slide, and then this is me trying to go to the previous slide. Let me just go, which I could not for now. So either with an industry outlook, or like there is actually a quality of earnings that was just released, like earnings call, and then it would actually incite people to buy more stocks. So that can actually be a reason. So this ends the portion for balance sheet, and then we will go later on the next video for the last one, which is the statement of cash flows. Thank you.